Good evening, everyone. Welcome to tonight's webinar. We were very excited. We've got a great presentation for you on how to protect the value of your practice through the dental office lease, especially during COVID. We're just going to wait for a few more attendees to join. As I can see, there's quite a number coming through as we speak. We're just going to give it a minute or so for everyone to join. And whilst we're waiting for everyone, just to go for a little bit of housekeeping. So tonight's webinar is CE accredited webinar. You will receive 1 CE credit for your attendance. This can take sort of 7 to 10 business days, will be sent via email. So there's a 2-part presentation tonight. I myself, Lee Tessler from Cirrus, and we have Patti-Anne Jones and Sevan Kadian from Tier 3. So we're very excited. We will get going soon. There is a chat feature as well. So if you do have any sort of questions, feel free to use the chat section of the Zoom. We will leave some time at the end for some questions and answers. So if we don't get to them immediately, feel free to use the chat. I'll just give it one more minute. And whilst we're waiting for just a few more attendees to join, you will see a little poll questionnaire come on the screen now. This really just gives us a bit of an understanding of your reason for joining today's webinar, just so we can get an understanding of your current situation. So appreciate if you could just take a minute just to fill that out. You know, if you have a lease, if you would like to speak to a Tier 3 representative about, you know, practice valuations, just gives us an idea of kind of what the attendance, what sort of healthcare professionals, where you are and what stage you are in your career. So if you can fill that in, and we will get cracking. So without further ado, very excited to introduce Patti-Anne and Sevan from Tier 3. So I will let you ladies take it away.
Thanks, Lee. So I still have the poll. There we go. Okay, I'm just going to share my screen. All right, everybody, Lee, can you see that? Perfect. Thanks, Lee, for inviting Sevan and I to participate in your webinar tonight. And thanks to all of you for joining us tonight, taking time out of your evening to come and spend an hour with us. So Sevan and I are going to kick it off, and we have 2 parts to our presentation. The first part is a question that everybody's been asking, and that is, how has COVID impacted practice selling prices? And the second part is going to be more specific to the lease and the lease's role in practice economics and selling prices. So if you're not familiar with Tier 3 Brokerage, we're a practice brokerage. We're a national firm. We have sales representatives from coast to coast. I'm a little disappointed that our web designer hasn't put it at the top of his priority list to add me to the map yet. But we do have sales representatives across the country, and I know that the attendees tonight come from various Western provinces, so rest assured that we have sales representatives in your province to help you with your practice appraisal and sales. We actually joined Henry Schein in January, which now makes us part of an international network of practice brokerages. So how has COVID impacted dental practices? Well, you all know that dental practices were shut down for about 3.5 months. And so there was a huge impact on dental practices in 2020. And we look at the financials from 2020, we see that, of course, billings are down anywhere from 5% to 35%. And how much they're down really depends on a number of different factors. One, of course, is staffing and how quickly after the shutdown your staffing came back. And of course, sometimes that was very difficult. Employees were worried about acquiring COVID. Some of them had underlying health issues that put them at greater risk. Some needed to stay home with children because daycares and schools were closed. Also, it depended on your type of restart plan. Some practices came back like gangbusters right after the shutdown. Others were a little bit more cautious, waited till maybe even the fall to come back. And some adopted protocols that were over and above what was required by the regulators. Also, if you were a practice that had a lot of senior patients, of course, their treatment was deferred. So those practices came back a little bit slower, and also depended on the prevalence of COVID in your area. If you were in a hot spot, then of course you were a little bit slower coming back than a practice that was in an area with few COVID cases. Earnings were also down, of course, and you all know that earnings is a determinant of value, and the earnings were down anywhere between 10 to 45%. That's what we were seeing. And that depended on a number of things as well, primarily the billings, but also things like whether or not the dentist took advantage of the different government subsidies, like the wage subsidy, the rent subsidy. And also we saw increases in expenses, like you all know, especially for PPE and staff wages. And of course, the staff shortage issue that existed before COVID was made worse by COVID. And that put upward pressure again on wages. But COVID is a one-time event, and one-time events do not need to impact practice values. So what we're seeing is that banks are back just like they were before COVID. They're loaning money at prime minus a quarter, which is about 2.2%. They're amortizing practice loans over 12 years. And some of the banks are even, depending on your personal financial situation, some banks are even loaning money at interest only for the first year or two. Buyers are also back. All of them, the market is very strong. We're seeing a lot of interest in the practices that we have listed. Those buyers are the individual owner operators, the investor dentists, the DSOs. And in our valuation process, we have done our very best in the last 12 months to find different ways to adjust out the impact of the COVID shutdown. And that has required an evolution of different approaches over the last year. And thank you very much to all the provincial dental associations who have done you a big favor, and they have raised the fees this year upwards of 4% to help with those increasing costs in the dental practice. Now, what we're seeing now with revenues post-COVID is that revenues are sometimes they're up, sometimes they're down. In some practices, we're seeing the revenues down, most commonly with the hygiene revenues, and we're seeing that quite a bit. And that's because a lot of the patients are still reluctant to come in. Also, if you're from a province where the regulator requires fallow times, or the hygiene regulator requires fallow times, or maybe you're a practice that just felt more comfortable implementing fallow times, then all of those things have had an impact on hygiene revenues. We've seen lower hygiene revenues. And you have to keep in mind that purchasers really like to see a strong hygiene program. It's the sustainable revenue for them going forward. So it is really important that you talk to your bin staff and really reassure your patients that the dental office is a safe place to come to, and that it's very important that they attend to their regular hygiene appointments and for their recall exams, and it's very important to their oral health. We are seeing in some practices the revenues are up. Most commonly, we're seeing that in dentistry. But don't get too overconfident, because sometimes we're seeing, a dentistry up about 20%, and the practice may be very stable with their dental revenue going into COVID, and now they're up significantly post-COVID. And it's questionable whether or not that's a new level of productivity, but most likely we're thinking that it's just the practice getting caught up on the backlog from the COVID shutdown. Because if you take 15 months of dental revenue and you pack it into 12, then you really should be up 25% in your dental revenue. And also you have a lot of patients that had to put off their dentistry because of COVID, and now they're faced with more extensive procedures. We're also seeing patients are back. When we do our patient counts, typically you would see attrition of about 8% in a dental practice. Those are the people that have moved away, or maybe they've passed away. We're seeing patient counts down about 10 to 20%. So not all the patients have returned. That 10 to 20% are not patients that have left the practice definitively. They're just delinquent patients. They just haven't come back. So again, it's important that you have your admin staff reach out to these patients, tell them that it's important for them to come back for their oral health. And then, of course, we all know this movie and what Jerry Maguire, his famous quote is, "Show me the money." So if you can show the purchaser the money, then the price is back. So if your revenues and your earnings are back to pre-COVID levels, then the value of your practice, the selling price, is back to pre-COVID levels. If you're not quite there yet, that's okay. You still have a very valuable asset, and you might just need a little bit more time. And so speaking of money, Sevan.
Thanks, Patti-Anne. So we're going to go into more details around your lease and how that affects the value of your practice. So for such a long time, landlords have had the upper hand when it comes to lease negotiations. Rent keeps going up, terms get worse, and it's the second or third biggest cost in most of your practices after wages and maybe before or after supplies, especially right now. But it's a critical component in your eventual selling price. COVID may have just handed all of you a really great negotiating advantage. We all know that commercial real estate is suffering. So there's empty places, people are moving remotely. Now might be the time to address some of your lease concerns, and you really have an upper hand here. They love dentists as tenants. You bring great walkthrough, people coming to their plazas. You don't default on payment. So you really should be talking to your landlord at this time if there's things you want to address. So simple question. So when we ask people about their leases, and these are some of the things that we hear, and I want to get you to think about, if I asked you, what was the most important determinant of your practice cash flow and selling price over the next 10 years? Do you think it's around your annual rent costs agreed to in your current lease? Do you think it's the length of your lease term and the extensions available to you? Or could it be the various clauses and conditions in your lease? So we get a lot of people coming to us and telling us, well, I've got 5 years, I've got a couple extensions, or I've got such a great rent price. It's so good. I've talked to all my buddies and mine's the lowest out of all of theirs. It's such a good cost structure. But then if we ask them, so what are some of those clauses in there? And lots of people don't know. And there's lots of hidden things in there. They're kind of sneaky, and leases are huge and daunting. So those are the kind of things that you need professionals to look at. So I'm going to give you an example here. So here's a sample practice. We made the billings $1 million. Don't get hung up on any of the numbers in here. If yours aren't like that, nothing wrong, nothing to be alarming. This is just for illustrative purposes. So we're going to look at a sample practice, what their expenses are. And rent is the one we're looking at here. So it's $70,000, 7%. As we take the expenses away from the billings, we also add in the dentist compensation, because as you're looking to evaluate a practice, there's always going to have to be that added in at, let's say, 40%. We come out with the earnings after the dentist compensation. So lots of people look at timesing that price by your earnings multiple. So that's tossed around a lot in Canada. Across the country, we see it ranging from 5 to 7%. And there's a lot of factors that go into determining what the earning multiple is on a practice. Times that with your earnings after compensation, and you come up with a selling price. If it were that simple, we'd be out of work. but if it's a good base point for you to kind of get an idea of where you're at. Things that we look are taking out your non-practice and non-cash expenses. Those are things that your accountant put in there to try and save you some taxes. We try and take them out to create more value for your practice. If it's attached to you as an individual and not to a business corporation, we try and take those things out. So looking at that rent that we were looking at, break that down. So base rent of $25 per square feet, add in the expenses, taxes, and you come up with the total rent for $70,000. But what if for some reason, and it could go both ways, maybe you're renegotiating and your landlord's like, well, I want to add more money to your rent. Like I want a 20% base rent increase. Maybe you go to them and offer this as a negotiating tool. Keep it in your back pocket, but just looking at why this could be a conversation piece. So if they raise it to $30 per square foot and your total rent comes to $78,000 after all that, you are going to see a difference, obviously, in your selling price of about $55,000 and 3.5% difference. So that sounds like a lot of money. And why would you want to do that? But we're going to illustrate more about why that might sound great to you. So this is a forecast that Tier 3 makes when we're listing appraisals. This is a tool that we use. If you look at year one and you can understand that, the rest is just inflation. So don't worry about the rest. So year one is taking those expenses we already looked at, and then we take away your dentist compensation and then taxes, and comes up with your cash flow, or EBITDA. So that's the money that's available to a purchaser for someone to repay their bank loan. So we're looking at this purchase price that we created of 1.5. And then after you have a forecast, a bank would create a loan repayment schedule. And again, this is something that Tier 3 creates. So again, getting ahead of the curve, getting friendly with banks before we're even talking to them, and lessening the workload for them. So hopefully they're in a better mood when they get to reading one of these. So if we're looking at a 1.56 loan on this, and you've got that money available to pay it back with, your surplus after that is $43,000. And that creates a loan coverage ratio of 26% in year one. So loan coverage ratio is just the amount of cash flow relative, or amount of cash relative to your loan commitment. Banks like to see this around 30%, no lower. So we're in a little bit of trouble already in the first few years because we're below 30% in the red. But we've already paid you out as a doctor. So you've got that money already, that 40%. So you could probably make a pretty good case that you're going to have no problem funding the rest of that if there's an issue with what you're already making. You don't have a outrageous lifestyle and it's no big deal. So a bank would probably be comfortable with that. But what if you only had 4 years left on your lease term and no renewals negotiated yet? What if there's a demolition clause, a termination clause, a renovation clause? They're availed as many different things. And that allows the landlord to terminate your lease in, let's say, 4 years. Or what if there's a relocation clause in there that allows the landlord to force you to move somewhere, but at your expense? They're not helping you with that. There's lots of things that could be lurking in there, and I'm sure Lee's gonna illustrate a few more of those for us later on. So let's imagine that year 4, we've got one of those things that's gonna cost us to potentially move. A bank's gonna say, that's going to happen. They don't want to guess about it. We're looking at a 12-year loan here. And if you have to relocate, it's average cost of $250 per square feet, coming to $425,000 capital investment that someone's going to have to make in this loan plan, this forecast. So a bank's going to put it in there. One way or another, they don't want to take that risk. Even if you get a 12-year loan here, lots of banks will even just say, well, you're only going to give you a loan up until that year 4 because we don't know what's going to happen after that. It happens all the time, and it's a really unfortunate thing. But let's imagine we've got to put this capital investment in at year 4 to relocate. Our loan coverage ratio is really off, and we can't even pay the first initial loan off by year 12. So a bank's going to no-go that. That's not going to happen for them. So what would work to them is offering $1.2 million for this practice. It's something that they say, this could work. This is what the practice is worth. We're not going to loan you any more than that. So that's a huge drop in selling price. That's $300,000 to $425,000 in difference. So that $55,000 bargaining chip earlier on doesn't look so bad now. So going back to what that simple question is, definitely worrying about where your lease term and extensions are, because if you don't have them yet, you can't bank on having them. And those various clauses and conditions in your lease could be really costly to you. So talking to a professional about that is key. Your takeaways, yeah, your leases and landlords, they're the #1 problem we have when it comes to selling practices. It can throw a real curveball in any step of the transition, and we can see it costing you hundreds of thousands of dollars, and the terms are way more important than what your actual lease cost is right now. And if you're looking to sell now and you haven't addressed these things, it's usually too late to change them. We usually have to work around them. Landlords know that you'll be making a lot of money on the sale, and they'll be coming for you for more of it if they know that you're at the end of your rope. So get out in front of the issue, have it reviewed, renegotiate when you have leverage, like now with the COVID, and use a specialist, because landlords are big companies. They do this all the time. It's good to have someone on your team to have your back.
Okay, thank you, Patti-Anne and Sevan. We've been working closely with, Patti-Anne and Sevan, especially in, BC and Western Canada, which is where I look after in terms of territory and specialize in before. And we have obviously a close relationship with Henry Schein. And they're a fantastic resource. I would definitely strongly advise, if you have any specific questions about transitioning, that are not covered here tonight, then definitely Patti-Anne and Sevan are extremely great resource to have on your team. So as we delve into a little bit more about the tonight's webinar. Just to give you a little taste of what I want to cover and what I want to talk about. Let's say give you a little bit of an update in the markets, pre-COVID, post-COVID. Look at some of the economics within the dental practice, and then we're going to sort of dig a bit more deeper into the lease agreement and how that can make or break the sale of your practice. How to avoid $100,000 mistakes through the assignment clause. We're going to look at one technical aspect of the lease and just go for a little bit of a practical, so you can actually see what some of the red flags we see in leases every day. And then we're just going to overview of how we can help mitigate some of the exposure and some of the risks within the lease. I think the key thing for me, if you walk away tonight, you not walk away as experts, but if you've learned something about how important the lease is to your practice, the location, the foundation of your practice, and as a tenant, how valuable, especially in this current climate, you'll see how valuable as a tenant that you are and will continue to be. So we crack on. 85, 54, 80. These are three numbers that I wanted to talk about. 85% of dentists have a lease that can prevent them from selling their practice. 54% of dentists across North America are overpaying in rent for their practice, and 80% of landlords structure the lease to give the landlord at least 50% of proceeds when the practice is sold. So, 85% of dentists, we know that you need consent from the landlord when it comes to transferring selling your practice and transferring the lease. The bottom line is the landlord is the key decision maker and can approve that or not approve that. 54% of dentists, you are going to pay some premium for a dental or healthcare practice. But what tends to happen is, you maybe had not such great advice, or you've signed a lease, you got very excited, and emotions run the better of you, a beautiful new practice, and with the rents escalating over a 10-year period, eventually those leases, the landlord's got knows that you're tied to that space, and before you know it, the rents have increased exponentially. And then the 80%, we see this all the time. And one of the things I'm passionate about is, if you're working 30 years and giving blood, sweat and tears, you do not want the landlord, you do not want to show him any of the money, as Sevan said before. So that's very key. So who are we? I think it's important that you have an understanding about Cirrus and how we've been representing the dental community for over 25 years now. So, we're a healthcare and dental specialist tenant representation firm. We were actually founded in Alberta back in '94 by dentists, for dentists, really for the reason that the landlord was taking advantage of the dental tenant. As you know, it can be a very expensive business to enter into, and as we're trying to maximize the value, it also can be a very profitable business when it comes to transitioning. Since our inception, we've negotiated over 12,000 leases. On average, we do over 500 leases per annum. And then what makes us unique is we do everything in-house. So we have a team of lease negotiators, all with a background in healthcare, some former real estate brokers, legal team, some lawyers on staff that have been representing us for over 10, 15 years now, and then a consulting team, which I'm part of. As you know, tonight's course is CE accredited. We do deliver over 100 continuing education accredited webinars and seminars when we've been allowed to travel. I think that the PDC last March was the last time I was able to travel and see everyone in person. So I mean, we're hoping that we can get back to that sooner rather than later. But we do lecture at most of the major dental conventions, the PDC, the New York, the Yankee. We really work with dentists nationwide. So I asked my operation team just to pull a slide. Just wanted to show some of the clients that we have worked with, and this list may actually go on for a bit longer than I planned. But as you can see, we you might even recognize some names, some doctors that we've worked with all across Vancouver, Richmond, Surrey, in Alberta, in Calgary, in Edmonton, Manitoba, Regina, you name it. We've really have and proud of the relationship and a lot of positive responses that majority of clients have said is the best money that they've spent on their practice. So I'm going to move this slide on. I just wanted to give a little bit of an update in terms of the market. As you can see here, this is really just looking at vacancy rates over the last few years and forecasting what that looks like as well going forward. So obviously there's been a slide most recently. Again, it's very market specific in Vancouver compared to maybe Calgary and Edmonton. Vancouver there's still a lot of demand there. And when you look at Alberta in terms of market rent, you can see that really what we're still forecasting, rents are not necessarily going down on renewals. There is definitely room for negotiations for sure. Landlords would really prefer, if they can, offering more sort of tenant improvement allowance, more other incentives, even on a renewal to keep you as a long-term tenant. they still like to keep the rent roll at the same sort of number. But again, it depends on whether you're paying fair market rents now or if you've been overpaying for a long period of time. Then there's definitely a discussion to be had. Overall, since 2020, since we COVID really came to the forefront, when we had the initial lockdown for the first 3 months, and it was one of the busiest times for us, as you could imagine, after everyone dealing with their staff. Then the rent was the next most important thing on everybody's mind. So we are seeing a little bit of a shift where a lot of businesses, a lot of people have been working from home. And will they go back to full time? Will they go back downtown to certain offices? That's definitely having some effect in terms of location, in terms of vacancy rates. What we're seeing is there's also been more opportunity now with a lot of vacancies in some of the other retail sectors, that we're seeing some good opportunities where somebody, maybe they wanted that market, where they wanted that retail storefront, and not necessarily in an office medical building. So they're taking some of that opportunity to maybe relocate. Look, in any market, in my experience, in my working life, in 2008 recession, even going back to 2000 and the tech boom stroke crash, there's always an opportunity in when a market is, when there's a downturn. Some people want to obviously see how things go. Some people are a little bit more risk averse, and will take the opportunity to maybe while rents, while there's opportunity to negotiate and while there's leverage to take that sort of opportunity. I think the overall thing is now everybody's starting to be double vaccinated, and fingers crossed there's no fifth wave. Things in the sort of third and fourth quarter, we will see a spike again. So this is still a great opportunity to take advantage of the current market. Dental supply equipment, I know Henry Schein for sure. There's lots of deals to be done. Banks' interest rates are very low. So there's still lots of reason to be positive for the future. So we pay for additional sort of proprietary data. We have access to sort of 95 billion square foot. We track over 4.6 million properties. So we really get access to market rates, market vacancies in the area. Again, we can take a deeper dive into your specific location because it depends on where you're at, what your type of building is, demographics. But we can certainly pull some reports if you're interested. Email info@cirrusconsultinggroup.com. So some of you I know own your own space, and you're probably thinking this is no use to me and what am I doing here? But I just want to just kind of bring your attention that, especially during COVID or pre-COVID, that plenty of dentists and people I've spoken to over the years of working at Cirrus, always thinking about buying that space and not wanting to, pay and continue to pay rent to their landlord. But there are pros and cons. It does require a large upfront financial investment. You do become your own landlord, so you don't have to answer to anyone. You can do what you want to the space and have greater freedom and control. But there's also now that a lot of the DSOs are taking over practices. They're not necessarily buying the buildings. They want to use their working capital towards building out those practices, remodeling, and also you still have the flexibility to relocate or expand. I mean, the key common denominator here is whether you lease or own a space, it's still extremely important, especially if you own, to have a lease that separates the two liability, the two separate holding companies, because in the future, if you do decide to sell the practice, you may want to keep the real estate, and anyone that's going to come in and buy the practice, they're going to have some sort of history of rental payments and a lease. And what is that lease going to look like? What control do you want if you become the landlord in the future? So there's definitely things to think about in terms of buying versus leasing. There's no right or wrong. So I really wanted to, get the point across that, leverage is key. And, you're extremely, as a tenant, one of the best tenants, you have the lowest default rate in the country. Statistically, you will stay in your space. There was a report recently with at least 22 years on average, a dentist will stay in their space. So, put yourself in the landlord's shoes, right? They've had one of the worst 18 months in a long time with vacancies, with defaults, big institutions, big corporations that can't pay rent. You still are able to practice. You need to, it's not something you can do from home. You need to be in the space, and you have to really understand the value that you offer as a tenant to the landlord. So I just really want to get that point across, that I speak to lots of clients on a daily basis saying, well, my landlord won't do this and my landlord won't do that. Well, maybe you're not having the right advice, and maybe you're not asking the right questions in terms of just agreeing to what they say and just moving on. So I really want to just kind of educate so that you can understand that you do have a lot of value, and again, depending on time frames and certain things, how we can advise you to benefit and use that leverage by making sure exactly what date when the lease expires, and we'll talk about that a little bit more as we go along. So most leases that I read, 50, 60 pages of leases many times a day, and I imagine if I could see all of you now, and if I was in a live seminar and asked all of you how many of you actually read your lease, front to back, majority, one or two of you may say yes, you have, but sheepishly, most of you will say no. To be honest, I've probably looked at the first 2 pages, looked at the financials, and put it in a drawer, and I haven't looked at it since. So it's really just to kind of, like I talked about, the landlord, this is what they do on a daily basis, right? They're not chairside. They're not, they're not placing implants, and they're not doing any endo, any perio. They're 100% of their time is dedicated to leasing. They're not chairside. They're not dealing with everything else, not just being a dentist, but have a family and everything. So as a dentist, you don't have experience in commercial real estate. You may have an interest, you may buy property, but you graduated from dental school for a reason, and that's what you enjoy. You enjoy the clinical side of what you do, and you're extremely busy. So it's important for you to understand. Now, one of the things that we did at one of my recent Henry Schein webinars, now I think we may be able to just add a quick poll to this. So do you feel like your landlord has more leverage than you during your lease negotiation? Just give me quick time to take some water. So we may be able to just quickly get the results of these, if you can just answer the question. So again, percentage-wise, 83% of you feel like the landlord has more leverage than you during the lease negotiation. So pretty much as suspected. And our job is to try and even out the field, to try and get to that level playing field, whereby what we're asking for is not it's not unreasonable. It's not to have a well-structured dental office lease, whereby you're still being a good tenant and paying rent and everything on time. But there's certain things that we need as a dental tenant. You can't just you can't move over the weekend. It's not like an accountant or lawyers. There's plumbing, there's equipment, and you're a different tenant. So there's definitely strategies that have proven that we've been successful, like I said, for over 25 years, and it's really just about educating the landlord. And we understand that you're still going to be at this building, you're still going to be working with this landlord. So it's not a question of trying to upset and go in guns blazing. It's having an expert negotiate the lease for you, because a lot of the institutional REITs, they have, like I said, they do this every day. They have their own lawyers and on staff, and the majority, you're not dealing with the landlord. You're dealing with their third party, someone working on their behalf. So we just want to try and even out the playing field. In terms of just some of the financials, there's 7 negotiables in your lease. What I want to try and for you to understand is, there's 2 sides and 2 parts to a lease. There's the financials, for example, these kind of financial negotiables, the base rent, annual increases. What is the rent? What does that look like? Is it increasing in line with inflation every year? Is it fixed for a period of time? We have a lot of questions about CAM and common area maintenance, expenses, additional operational costs. If you're paying X amount for additional expenses, are some of the work, if it's snow removal, garbage removal, whatever it is, you want to make sure that, one, you're paying for what's actually being done, and just understand what that looks like. There's a lot more incentives now if you are looking to, like I said, start maybe a second practice or relocate. Landlords are looking to really incentivize on new builds with free rent, whether it's tenant improvement allowance and landlord work. But what I want to try and get across is, yes, the financials are extremely important, and depending on what stage of your career, if you're a young graduate and you've just started your own practice, then the financials are going to be tight, and what you pay each month, rent and expenses is going to be very important to you. If you're coming up to transitioning or retiring, then saving $1 a square foot, or making sure that you can actually assign the lease, the difference there in making sure the language is structured, and we'll take a little bit of a deeper dive into one of the provisions in a minute. But you'll understand that saving $1 or $2 per square foot, yes, that can be beneficial. But if you're looking to retire in the next 2 to 5 years, and you may save a little bit of rent per annum, or it's more important that you can actually sell that practice for 1.5 million, like Sevan was talking about, or if there's a demolition, or if there's a clause that you can't actually assign the lease, and that could cost hundreds of thousands of dollars. So again, the importance of a properly structured assignment clause. So the assignment clause is one of the most key provisions within the lease. Again, my professional experience, you want to get this right and you want to get this structured, the sooner the better. Yes, if you've just started a practice, you may think, well, I'm not selling for another 10, 20 years, and that's not a problem. Maybe it's not a problem there and then, but it will be a problem in the future. And certainly on my experience, on what I see, to get the assignment language structured properly, the sooner you do that, the better. So I want to just take a little look into this is an assignment provision that is found in 75% of dental leases. And I'm going to just give you just a quick minute just to have a quick read over that. Bearing in mind, I read 50, 60 pages of leases every day. So just take a minute to have a look at this paragraph, see if there's anything that stands out or any kind of red flags or anything untowards that you notice or don't notice. So I'm going to just going to run through some of the practical points in this lease. So first thing, it says that, if the tenant wishes to, assign or sublet the lease premises, it shall first have received consent from the landlord. Now, as I said, this is normal. The landlord is not going to let you just sell or transfer the lease to any Tom, Dick, or Harry. It's his building, and essentially he's going to want to put in some conditions to make sure that the person taking over the lease is going to, is fit and proper and has good credit history. But as you will see as we sort of go along, and we look at some of the other language as we go along. So in this lease, it says that, the consent should be in writing, and, the landlord will have three options. One, simply just to approve the tenant's request to sign the lease. Two, decline the tenant's request. And three, can terminate the lease agreement upon effective date of such proposed lease assignment. So just by asking the question here, the landlord can actually just terminate the lease. We refer to as a termination clause or provision. Now, here the landlord shall have the right to revise the minimum rent to be paid during the remainder of the term to the greater of the current market rent for the lease premises, or 15% greater than the current rental rate. So the landlord says, okay, so I'm willing to approve the assignment and the transfer, but just to let you know, I'm going to be increasing the rents 15%. So you may want to inform your buyer. Now, if I'm that buyer and I've agreed a price, and I just then get told that the rents are going up 15%, the first thing I'm going to do is probably reduce my offer by 15%. Now, this second from last paragraph, it says that should the assignee, should the tenant from the assignee receive any sort of cash, goods, any form of consideration in connection with the assignment of the lease, then the premises above the current base rates payable in that fiscal year, the difference of the annual rental income or other consideration shall be paid directly to the landlord. So if you were paying, say, $60,000 per annum and you're selling your practice for $500,000, right there and then the landlord is entitled to $440,000 of proceeds of sale. Now, again, I would like to see a lot of you faces and in person, but this is in 75% of leases. Is it 100% of proceeds? No. In some cases, it may be 50%. But just that language, right? That the landlord knows that, at the 11th hour, you've dotted the I's, crossed the T's, you found a buyer, and then the last minute you just ask the landlord for permission to transfer the lease and says, yeah, no problem, but I want 50%, or I want some consideration. We had a client that was selling their practice for $2 million and had some detrimental language in the lease and was desperate to sell and had a buyer at $2 million and agreed and had to agree and paid the landlord $125,000 just to assign the lease. So it does happen. It shouldn't happen, but it does. And then the final kicker, if you think it can't get or couldn't get worse, landlord eventually agrees again to the transfer, and it says the tenant shall not be released from its obligations under the lease and shall remain liable for any failure of the tenant or its assignees to observe each and every covenant of the lease. So you've managed to actually go through the 3 or 4 steps. You've assigned the lease, but the landlord will not release you from any continuing liability. So we had a doctor that had sold his practice, young associate who took on far too much debt, bought a nice big house and car, and 4 years later he went bankrupt, and the landlord went after the selling dentist, who I'm not sure if he was on the golf course or at the beach or cottage, but the last thing he wants to do at that stage is have to go back and start practicing dentistry. So, this is just one small provision. And within this provision, which is found in 75% of dental leases, there are 5 or 6 red flags that can have a significant impact and cost. Having to relocate unexpectedly, you're absorbing a significant increase in rent, and just the inability to sell your practice is a liability of anywhere from $200,000 to $500,000. Now, just for the interest of time, and like I said, when we look at the financials and when we look at the legal provisions, there are 25 other clauses. I'm not going to go through each one of those today because I want to keep you sane. But there's demolition, relocation, death and disability provision. That's something that we've really prided ourselves on trying to add to every lease that we negotiate. God forbid something was to happen. If you sign a long-term lease, that provision will enable your estate, your family, to terminate the lease agreement regardless of the number of years remaining on the lease. So again, if you're unsure, if you have any lease, any concerns, feel free to email your lease. We will be offering a complimentary lease review to everybody that's attended. We'll talk about that a little bit later, but there's this slide. So this is a slide we actually got from from the landlord side. So we hired one of our lease negotiators who used to work on the landlord side, and I really like this slide because it just gives you an idea of what, from a landlord's perspective, to what a tenant, what you're seeing. So one of the reasons we recommend strongly to, first of all, know your critical dates, right? Know when the lease expires, know when, if you've got any options, how much notice do you have to give, 6 months, 9 months, a year, 30 days. Know your critical dates. That's key. But when we recommend that's starting the process, or at least to with at least 24 months prior to expiry. And the reason for that is, again, landlords can take their time, things can happen, and we want to start as early as possible for the reason that if there is an issue, if there's a problem, that you have the opportunity and the time to make an informed decision. If you, worst case scenario, if you did need to relocate, a landlord, lots of them, and they're very savvy landlords these days. They may say, "Oh, you've got loads of time. Come back to me in a year." They want to get you into this kind of 8 months position. They are not going to tell you when your lease expires. They're certainly not going to tell you. Most times you've got an option to extend the lease, but you have to obviously give that notice. If you miss that notice, then great, even more leverage for them. They want to get you into that red 6 months prior, because the chances are they know that you don't have enough time to relocate, even if you want to or not want to. They know that they put something in front of you within that last sort of 6 months, then you haven't really got much of a leg to stand on, and you've lost a lot of your leverage. So that's one of the reasons that we say within 24 months before expiry that you should definitely start the process. Now, why have we sort of been successful? Lots of questions of, well, how have we been so successful? We've been doing this for 25 years, and one of the reasons for having over 100, I think, 5-star Google reviews, we have a process that, we gather all the information, gather all the documentation. We look at the lease. We look at it for any sort of liabilities, any areas of concern. We also take a deep dive into your career, your practice, what stage you are at in your career, and and identify some of the more key and more important things that you want to try and achieve, and where you are in your career, because again, that can affect the strategy. We review the office lease for any risks, any liabilities, any area of concern. Like I said, we then prepare the market research, like I talked about before, and looking at the area, the current rental rates, the variables, with our own proprietary data and our own, all the leases that we've negotiated, and then we develop an outcome and a strategy. And at this stage, what we haven't done is even reached out to the landlord. Now, I don't want you to be thinking that the minute you get off this call that I'm going to look at my lease and find my landlord and say, have I got this, that, the other in my lease? And that's one of the worst things you can do. The way that we are successful is going into these conversations, having the information, knowing what we're trying to achieve. Look, every negotiation there's high, medium, low items. There's going to be some things that you're going to have to concede in any negotiation. You're not going to get everything, right? But we will then, once we reach out to the landlord, we spend 15 to 20 hours on the financial economics of the lease, and probably at least 20, 25 hours on the legal terms and the legal provisions. We then do a final review and an executed lease agreement that hopefully everybody's satisfied with. Just some of the recent Google reviews that I talked about. We had a dentist who was 74 years old and was forced to relocate his practice. We were able to get the new landlord, to cover 100% of the build out costs, and make things reasonably smooth for a 74-year-old. The last thing he wanted to do was relocate his practice. So, we've had some really good success, and we're really confident in what we do. So one of the things that I did want to talk about was this critical dates and risk analysis review, which is a normal value of 1,995, whereby we would spend 3 to 4 hours analyzing your lease for traps, like we talked about. We would then get on a call and go over some of our findings. We'll have a look at some of the traps and uncover what that means to you. And we'll talk about an effective treatment plan. Now, thanks to Henry Schein, thanks to our sponsors, we are pleased to offer this as a complimentary service. It is on a first come, first served basis. Now, I know a number of you have got leases that are expiring within the next few years, so I would strongly recommend. It's really a really beneficial service. Like I said, normally costs nearly $2,000. So you can send it to info at cirrusconsultinggroup.com, and it's on a first serve, first come basis. Now, I want to thank you for attending, and hopefully we still have some time for some questions. Also, there's an exit poll, which has probably just come on your screen. Again, if you could just take a minute or two just to fill out this exit poll in terms of, if you are a tenant, when does the lease expire? Is your situation urgent? And if you are interested in that complimentary lease review, then, please let us know with ourselves at Cirrus and the ladies at Tier 3. If you do want to speak to someone, we will reach out to you. And we can answer some more questions and spend some more time with you. If there is any questions, I know we're just over the hour mark, but I'm still available, and I think Patti-Anne and Sevan as well have made themselves available for some questions before everybody goes. If I could just have a look if there's any questions. So feel free to use the chat function. Okay, I'm just having a look if there's any questions on the chat. Come on, someone will lead off with some questions before you go.
Maybe we explained everything so well.
Yeah, I mean, I'm going to take it as I'm going to just stop sharing my screen so you can see us all in person.
Oh, there's a question.
I'm going to take that. Okay.
Lee, I think you could take that one.
Okay, so there's one question here saying, I have tried numerous times to contact my landlord, but he always has excuses not to renew the lease. Now, that's a perfect question, or really what we've talked about for the last half an hour. Then I would first of all strongly suggest that we speak as soon as possible, because there are a number of reasons that this could be happening, as we've talked about. But we don't know if something else is happening within the building, or there's a reason why they don't want to renew the lease. But clearly that is a huge red flag that we want to address. So I would suggest that we take that offline. But again, these things happen. If you may not have any options left, and the landlord may have other plans for the building, and making excuses. It can happen, but we need to address that. We need to address that quickly. Let me just see if there's any other question. Let's just have a look at, we've got some more questions coming in. Cam Harris, thank you. Great presentation. Peter Kearney, how far in advance of starting leasehold improvements is ideal for lease negotiations? And that's a great question. I was actually just speaking to someone this week who the lease doesn't expire for 3 years, but they're looking at doing a massive renovation. So, there's no hard and fast rule in terms of, we obviously the 24-month window is when we talk about renegotiating. But if you are about to, put a lot of investment and a lot of money into the space, then, generally there's a reason potentially to maybe open up the lease and maybe extend. You want to commit, you're about to spend, a lot more money into the space. So I would certainly say in terms of how far in advance, but what I would say is if your lease is expiring and you think, oh, well, it doesn't expire for 3-4 years, so, there's nothing I can do. If you're about to spend a lot of money in leasehold improvements, then there's an opportunity to negotiate. There's always an opportunity to have a conversation. Yeah, the landlord can say, your lease is what it is and come back to me in a few years. But like I said, in terms of strategy, if you're about to spend a lot of money in that space, and as far as the landlord's aware, you could say, well, I'll go and spend that money somewhere else. I won't renew the lease in a few years. So it's leverage, negotiation. A few more people. Any other questions?
So Lee, I've got a question for you. So I don't see any other ones popping up in the chat yet. So let's jump in. So one of the biggest time bombs we always run into when we're appraising a practice or looking to sell a practice is, and we look at the leases, we see like Sevan was talking about, either a demo clause in there or a relocation clause where it's at the tenant's expense, or maybe the landlord's paying for the leaseholds, but at the depreciated value of the leaseholds, or different things like that. And I know, and obviously, even if they can't get those clauses out of the lease, it's at least better if they can defer them out as far as possible. That would have less impact on the value of their practice. But when you're going in to negotiate, and I know the circumstances will be different from client to client, but what sort of approaches do you take to be able to convince a landlord to remove that demo clause once it's already in there?
Yeah, I mean, look, there's different approaches. I mean, I think, best case scenario when we go into a situation with a demolition clause, best case scenario is to try and remove it. As simple as that. But in a lot of downtown area, Vancouver, Toronto, there are a lot of demolition clauses, and there've been demolition clauses that are in there, and they will continue to be in there. So in some of the ways that we can actually help limit the liability is to, insert maybe a blackout period whereby, they can't do anything for 10 years. And then take the approach of, well, let's have 1 or 2 years notice, right? So there's little things that you can do rather than just, there's a straightforward demolition clause, and, you can be kicked out within 6 months notice. So, there's different approaches in terms of how you can actually limit that liability. It doesn't have to just be, right, this is the demolition clause and that's it, and it's not going anywhere. Again, it's about educating the landlord and they know that the dentist that they're going to be there a long time, and that's going to have a detrimental effect on their business. So I hope that answers your question. I've got your doctor's hat on. I did have one other question that I want to answer in terms of, do we help with finding locations for new startups? So yes, we do. I mean, we're not traditional. We're not brokers. We do work with good brokers, especially in Alberta and BC. We have good relationships with the Cushman and Wakefield team. So we definitely can help find locations. We do have good access and good inventory as well. So we do get a lot of landlords that will come to us directly. They know that we have, a good clientele of good tenants that may be looking for space. So when they're, building out a new property, sometimes they will come to us before it may have even gone on market. So yes, we can help you with that. I am conscious of everyone's time. I think unless anybody's got any other questions. There's one other question here. I think it's saying it is being recorded. We will be able to have a link to the recording. I know probably in the next few days. So again, I just want to thank Patti-Anne and Sevan for spending time with us this evening. I hope everybody's really enjoyed it. Appreciate everybody's time, and stay safe. And we will be in touch. Please send all your questions to info@cirrusconsulting.com and send your leases, and we will speak to you all soon. Have a great night.
Thanks, everyone.
Thank you very much.
Bye. Thanks.